Hey everyone, welcome back to the channel. It's Demetrius. Today, I want to share a story with you about a client of mine who made a pretty significant decision in her financial journey. And it's a story about why she chose to put $15,000 per year into whole life insurance and what drove her to this decision. And so if you're someone who values safety and liquidity in your financial plan along this whole financial journey, you're going to want to stick around. All right, so this client in particular, she's a very successful middle-aged woman with a steady income from rental properties. She was initially presented with the idea of whole life insurance versus index universal life insurance, commonly known as IUL. Both have their benefits, no doubt. But for her, the choice was clear. She didn't want the fluctuation that often can come with index universal life insurance, especially when it comes to her cash value. Now, my client in particular was drawn to the idea of uninterrupted growth. So growth that never stops regardless of market conditions. And that's exactly what overfunded whole life insurance offers. Now, she didn't plan on using the cash value too often, but she wanted a place where she could store her money, not only grow it, but also have some access to it without halting or stunting its growth. This was a very crucial factor for her. Through conversations with her and through her own research, she had an epiphany. She realized that life insurance companies are some of the biggest and most liquid financial institutions in the entire world. For every dollar that you put into a life insurance policy, these companies typically have 2 to 3 times that in reserves, if not more in a lot of cases. This was an absolute game changer for her. Now let's talk about safety for a moment. Banks are often seen as safe places to store money. And to some extent, that's very true. But my client understood something critical. When you store your cash in a life insurance policy, that safety level increases dramatically. So why is that? Because banks operate on a system called fractional reserve lending, which just means that they can lend out 9 to 10 times more than they actually have on reserves. That's how banks actually make money. But it also means that situations like the collapse of Silicon Valley Bank, there just wasn't enough money to go around. Life insurance companies, on the other hand, are fundamentally designed to be different. They hold every single penny of your cash value on hand, plus the amount they're actuarially going to have to pay out in death benefits. These companies are designed to weather financial storms. Now, my client saw this as a huge advantage. She realized that while banks are a standard choice, life insurance policies take safety and liquidity to an entirely different level. And that's why she chose to work with me and my team to secure her financial future with whole life insurance. This story is just one of 5 core reasons why people that I work with on a daily basis decide to put their money into overfunded whole life insurance, right? If you're interested in learning about the other 4 reasons, make sure to subscribe and hit the notification bell so that you don't miss out, because we'll be diving into those in upcoming videos. So if you're considering how to protect and grow your wealth with safety and liquidity in mind, maybe it's time to explore whole life insurance. It's not just about life insurance coverage. In other words, it's not just about the death benefit in and of itself. It's also about making your money work for you in the safest way possible. So be sure to find someone that you trust who does this on a regular basis and that has experience with designing these types of policies for high levels of cash value. And if you don't know who to turn to, or if you just want to learn more, feel free to reach out and let's have a conversation for free. Thanks for watching, and don't forget to like, subscribe, and share the video if you found it helpful. See you next time.